U.S. economy grew more than expected in the second quarter. This, according to the Commerce Department, growth hit 2.4%. It's a sign, the White House says, that the Biden's economic plan is working. Benji Heyer starts us off.
The economy here is growing. Amid fears of a lockdown, growth has, in fact, accelerated, quelling concerns of an imminent recession. The rise in GDP reflecting changes in consumer habits, a surge in private investment, and increases in government spending. It follows one of the Federal Reserve's most aggressive monetary tightening cycles in decades, hiking interest rates again on Wednesday. That's 11 times in total and up more than 5 percentage points since early last year, all in a bid to tame inflation, which had hit a 40-year high. Now, greater borrowing costs can and do commonly hinder growth, but economic activity has proven resilient. The Biden administration is taking credit. It says these statistics are proof of what it calls Bidenomics in action. Our unemployment rate remains near record lows. Inflation has fallen by 2/3, a White House statement reads. And it adds, we're just getting started. Welcome news to the ears of many business owners and working families. Yet future interest rate rises could dent growth further down the line, and inflation remains a thorny challenge. On Tuesday, the International Monetary Fund raised its 2023 global growth estimates slightly, but in doing so, the IMF warned that persistent inflation is dampening the outlook, and the risks facing the global economy still remain tilted to the downside. Benji Heyer, CGTN, Washington, D.C.
For more on the U.S. economy, John Quelch, professor at the University of Miami's Herbert School of Business. Good to see you. This is very interesting because 6 months ago, we were talking about the U.S. possibly going into a recession. We were talking about housing prices dropping. We were talking about inflation hurting the consumer, which would hurt growth. Today, I don't hear anybody saying any of those things. What happened in the last 3, 4, 5 months?
You're correct, Phil. Around about 75% of economists are now forecasting that the probability of a recession in the second half of this year is 50% or less. And we have seen 4 consecutive months of housing price improvements after a decline in the housing price rate previously. The Consumer Confidence Index is now at a 2-year high. So there is a tremendous amount of positives in the economic scenario in the U.S., proving, I think, to some extent that the U.S. is a very resilient and innovative economy in the face of downturns.
Right. But Professor,
yes.
I would also add that it did not happen naturally, right? Because the White House and the administration, you could argue Biden or Trump, both are responsible for the stimulus packages during the pandemic and post-pandemic, including the Inflation Reduction Act. All those were actually inflationary, and they essentially were either government spending or government giving money to the private sector to spend. All of that is still in the system today. It is still a catalyst for the economy. But at the same time, you've got the Fed trying to tell everyone to stop spending and to slow it down. I feel like you've got both going on.
Well, you are making in a comical way a very good point, and that is that the fiscal stimulus, on the one hand, was essential to get the country out of the COVID drawdown, but on the other end of the string, the Fed is, of course, tightening interest rates to slow the economy down. Now, one thing that is important to note is that in the latest growth figures, there is considerable increase in non-residential factory construction. That's related to the infrastructure investment that Bidenomics has been sponsoring. Meanwhile, the consumption of the individual household has been moderating in the latest growth statistics. So you're seeing a little bit of a pivot away from consumption and towards investment, reflecting, I think, that the money that was channeled to individual consumers is now drying up, but the money that has been channeled into infrastructure
Fair enough. What then explains, and you brought this up, what explains the fact that consumers appear to be so resilient? You know, we hear bits and pieces that people are cutting back, but we simply don't see it in the numbers, right? The consumer confidence is off the charts, and I think it's a surprise to a lot of economists that thought that would not be the case. Is it really just purely a function of people being employed?
The American consumer has difficulty adjusting his or her lifestyle as the economy goes up or down. You know, many consumers have, of course, blown through the Biden stimulus money that they received. They are drawing down on their savings. They are extending their credit as permitted by banks and credit card companies to continue to maintain their lifestyle. And, you know, this could present a problem further down the line. But at the moment, we see, as you describe it, a resilient consumer, but in some respects, that's a consumer that maybe not that sensible in the way in which they're conducting their spending patterns.
Professor, if the rates stay where they're at, and I looked today at the 10-year Treasury yield, it just peaked over 4%, and I hadn't seen that for quite a while. I think the 2 years close to 5%. So these are numbers for the audience that's watching. It's essentially the risk-free rate of capital, right? It's if you do nothing, you make 4 or 5%. So my question is, when you speak to your friends about the U.S. economy, do you think that there has to be job loss to slow the consumer down? Because I don't see any other possible way that what you said, they don't want to make the adjustment. Well, they have every right to go to the bank and borrow money and spend money. I don't see anything wrong with that.
Well, 209,000 jobs were added in June. That is not as high by any means as it has been in the last year, but it's still very robust. In my opinion, there is still a large number of people who dropped out of the workforce during COVID. And so the unemployment rate is low in part because of the exit from the workforce of so many people during COVID who retired or semi-retired and just haven't come back in. But what I would say in addition is that from the Fed's point of view, they are still targeting the 2% inflation rate. And at the moment, we're still at least 1% or 2 percentage points short of that.
We're well short of it. And Professor, this is my other question, is it unrealistic that the Fed wants the economy to remain, I guess, resilient and strong, while at the same time wants essentially 0 to 2% inflation? The two, again, seem to contradict what you're trying to accomplish.
Well, it's a balancing act. We know that the Fed was late to the game in the first place. They lost a lot of credibility by being late to the inflation fight, and now they're trying to make up for lost ground by relentlessly going back after that 2% target level. So I would not rule out a further 25 basis point increase later this year if the economy continues in its current state of relative robustness.
All right, Professor John, good to see you. Thank you.
Thanks, Phil.